Welcome to the TaxSlayer Pro Basic Income Tax Preparation course. This is Module 9, Adjustments to Income for filing 2018 tax returns. Adjustments to income now show up on the new Schedule 1 for 2018, Form 1040, lines 23 through 36. Some examples of adjustments for 2018 are Educator Expense Deductions. We've had this one in the past. Health savings accounts. Moving expenses have changed. Now moving expenses are for members of the armed forces. Individual retirement arrangements, IRAs. Alimony paid. And again, keep in mind that 2018 will be the last year for using alimony as an adjustment to income. And the student loan interest deduction. The tuition and fees deduction has been suspended for 2018 tax returns. These adjustments to income are considered to be above-the-line deductions. This means that you can claim these deductions even if you don't itemize deductions on your income tax return. Also, above-the-line deductions are not subject to phase-outs based on income levels, and their deductions from your gross income rather than your adjusted gross income. First, let's look at educator expense deductions. An eligible educator can deduct up to $250 of unreimbursed expenses. This includes classroom materials such as books, supplies, computers, including related software, and services or other equipment that an eligible educator would use in the classroom. Qualified educators are employed by kindergarten through grade 12 programs. Examples are teachers, instructors, counselors, principals, and aides who are in a school for at least 900 hours during a school year. Daycare and nursery school teachers are not eligible. The amount of the deduction is $500 if married filing jointly and both spouses are eligible educators, but not more than $250 each. The deduction is claimed on line 23 of the new Schedule 1, Form 1040. So, just to review, Jack and Jill are teachers. Jack teaches 5th grade at a public school, while Jill teaches pre-kindergarten, which is attached to a private daycare facility. Jack paid $310 for ordinary and necessary classroom expenses. Jill paid $270 for ordinary and necessary classroom expenses. Neither of them were reimbursed for anything. So what would be the correct adjustment for educator expenses on their joint tax return? $310, $250, $500, or $580? In this case, $250. Jill is not an eligible educator. The maximum adjustment is $250. Jack can't claim the full amount of $310, and only Jack is eligible. Health savings accounts are tax-deductible savings plans that allow a taxpayer to save pre-tax dollars for future healthcare expenses. HSAs are paired with high-deductible health insurance plans. Contributions to an HSA are tax-deductible. Earnings, such as interest and dividends in the health savings account, are tax-exempt at the federal level. Withdrawals from a health savings account are tax-free as long as the funds are used for qualified medical expenses. In other words, a health savings account, or HSA, combines high-deductible health insurance with a tax-favored savings account. Money in the savings account can help pay the deductible. Once the deductible is met, then the insurance starts paying. Money left in the savings account earns interest and is yours to keep. 3 ways an HSA can offer tax advantages over traditional health insurance arrangements are: 1. It reduces your federal income taxes, regardless of how your income was earned. Any money you deposit into your HSA is considered an above-the-line deduction, giving you a 100% write-off against adjusted gross income. Second, reduces your adjusted gross income, helping you to qualify for other tax breaks tied to overall income. By reducing your AGI, you may also qualify for additional tax breaks. For instance, the child tax credit of $2,000 begins to be phased out once a single filer's adjusted gross income exceeds $200,000. Keep the AGI below this number, and the full $2,000 tax credit per child is maintained. Third, reduces state income taxes. Federal adjusted gross income is also the starting point for most state tax assessments, so saving on your state income tax bill is also possible. Here's Form 8889. Health savings account deductions are reported on this form. And then to Schedule 1, line 25. And finally, to line 7 of the Form 1040, reducing the taxpayer's income. And next, a substantial change for 2018 tax returns in regard to moving expenses, Form 3903. The moving expense deduction has been eliminated except for certain armed forces members. For tax years beginning after 2017, you can no longer deduct moving expenses unless you're a member of the armed forces on active duty and, due to a military order, you move because of a permanent change of station. So which moving expenses can be deducted? Moving household goods and personal effects, and travel at 18 cents a mile. Moving expenses from Form 3903 flow to the new Schedule 1, line 26. And then to line 7 of the Form 1040, reducing the taxpayer's income. Now we've already talked about line 27, the deductible part of self-employment tax from Schedule SE that gets generated by the profit on Schedule C, business income. And beyond the scope of this course are self-employed, SEP, simple, and qualified plans, self-employed health insurance deduction, and domestic production activities deduction. Next, the penalty on early withdrawal of savings. If you withdrew money from a CD, certificate of deposit, or other time deposit savings account prior to the certificate maturing, you may have incurred a penalty for early withdrawal. This penalty is charged by the bank and withheld directly from your proceeds from the certificate. And where do you claim this? The penalty is reported on Form 1099 INT, Box 2. And we enter this figure on line 30 of Schedule 1, Form 1040. For 2018 tax returns, alimony is income to the recipient and a deduction for the payer. The IRS has a line for you or your client to fill in the ex-spouse's Social Security number. Even if you and your ex aren't on speaking terms, make sure you both have the same alimony payment in your respective slots. Amounts paid under divorce or written separation agreements entered into between you and your spouse or former spouse are considered alimony for federal tax purposes if you and your spouse or former spouse do not file a joint return with each other. You pay in cash, including checks or money orders, and if legally separated under a decree of divorce or separate maintenance, you and your former spouse are not members of the same household when you make the payment, and your payment is not treated as child support or a property settlement. Not all payments under a divorce or separation instrument are alimony. Alimony does not include child support, non-cash property settlements, payments that are your spouse's part of a community property income, and voluntary payments. Next, IRA deductions. They're reported on Schedule 1, Form 1040, line 32. Now, taxable income can be reduced by contributing money to a traditional individual retirement account, or IRA. Contributions to IRAs can be made as late as the first due date of a tax return, usually April the 15th, and can be retroactive to the previous tax year. An IRA is a personal savings plan that offers tax advantages to set aside money for retirement. Why would you want to set up an IRA? Some or all of the contributions may be deductible, and amounts in the IRA, including the earnings from the account, are not taxed until they're distributed. You can set up IRAs with banks or other financial institutions, or with a mutual fund or life insurance company. You can also set up an IRA with your stockbroker. You've probably heard the term Roth IRA. Let's look at traditional IRAs versus Roth IRAs. The main difference is when income taxes are paid on the money that's put into the plans. With a traditional IRA, taxes are paid on the back end, that is, when the money is withdrawn during retirement. With a Roth IRA, it's the exact opposite. Taxes are paid on the front end, but there are no taxes on the back end when the money is withdrawn. In both traditional and Roth IRAs, money grows tax-free while it's in the account. Almost anyone with earned income can contribute to a traditional IRA. There are income limits for contributing to a Roth IRA. Roth IRAs are more flexible if you need to withdraw some of the money early. And with a Roth IRA, you can leave the money in for as long as you want, letting it grow as you get older. With a traditional IRA, by contrast, you have to start withdrawing the money by the time you reach age 70 and a half. Traditional IRA contributions are tax deductible on both state and federal tax returns for the year that you make the contribution. Withdrawals in retirement are taxed at ordinary income tax rates. Roth IRAs provide no tax break for contributions. In other words, contributions are never deductible, but earnings and withdrawals are generally tax-free. So, with traditional IRAs, you avoid taxes when you put the money in. With Roth IRAs, you avoid taxes when you take it out in retirement. All money is tax-free when withdrawn if the qualifications have been met. Any payment or distribution made after the 5-year period beginning with the first taxable year in which a contribution was made is called a qualified distribution. It's made on or after the taxpayer reaches age 59 and a half, or a qualified distribution could be made because the taxpayer is disabled, made to a beneficiary after the taxpayer's death, and a qualified distribution can be used for a qualified first-time home purchase. Now, there's a $10,000 limit on this. So how much can you contribute to an IRA? For 2018, the dollar limits for IRA contributions were $5,500 if you're age 49 or younger, $6,500 if you're age 50 or older. And the earned income requirement for IRAs, to be eligible to fund an IRA for a particular year, you'll need to have earned income. For IRA purposes only, earned income consists of wages, reported on a W-2, self-employment income from a business or farm, and alimony. The most that can be contributed to a traditional IRA is the smaller of your taxable compensation, including wages and earnings, or $5,500, $6,500 if you're 50 or older. For example, Betty Rubble, who's 34 years old and single, earned $24,000 in wages for 2018. Her IRA contributions for 2018 are limited to $5,500. Barney Rubble, who's a single college student working part-time, earned $3,500 in 2018. His IRA contributions for 2018 are limited to $3,500, the amount of his earnings. If the taxpayer chooses to contribute to a traditional and Roth IRA, the total of all IRA contributions cannot exceed the contribution limits. Excess contributions could result in a penalty. If a taxpayer contributes more than $5,500 or $6,500 if age 50 or older in 1 year to an IRA, he or she will be penalized 6% tax on the excess contribution and its earnings each year until he or she withdraws the excess contribution and its earnings. Funds can be contributed to a traditional or Roth IRA by the first deadline of a tax return without any extensions. That means a taxpayer can make a retroactive 2018 IRA contribution if he or she funds the account by April the 15th, 2019. Continuing on with IRA deductions, a taxpayer must be under age 70 and a half to contribute to a traditional IRA. Contributions to a traditional IRA might be deductible or non-deductible, depending on age, total income, and whether you are covered by a retirement plan through your employer. Form 5498 reports IRA contribution information. Your IRA trustee or issuer, not you, is required to file this form with the IRS by May 31st. Again, this is simply an information form. You won't find this form in TaxSlayer, nor do you file it with your tax return. The copy you receive in the mail is a copy for your records. Form 5498, again, reports the various types of IRA contributions made in a number of reporting boxes. Box 1 shows the amount contributed to a traditional IRA. Box 9 reports the amounts contributed to a savings incentive match plan for employees or simple IRA. And Box 10 covers the amounts that you put into a Roth IRA. And one last thing, Form 8606. Form 8606 is used to keep track of non-deductible IRA contributions and the basis of a taxpayer's IRAs. Taxpayers who make non-deductible contributions must file Form 8606 with their tax return. This form is also used to report taxable distributions from an IRA, and the interest earned on the non-deductible portion is tax deferred until it's withdrawn from the account. Now let's look at one of my favorites, the student loan interest deduction. Schedule 1, Form 1040, line 33. Interest paid on a qualified student loan may be deductible. A qualified student loan is a loan taken out solely to pay qualified higher education expenses. Generally, the amount deductible is the lesser of $2,500 or the amount of interest that was actually paid. Student loan interest is reported to the taxpayer on Form 1098E, Box 1. And it's reported again on line 33 of Schedule 1. Here's an example of Form 1098E showing the student loan interest received by the lender in Box 1. The deduction can be claimed if all of the following apply. Interest was paid on a qualified student loan during the tax year. The taxpayer is legally obligated to pay interest on a qualified student loan. The filing status is not married filing separately. If you're married filing separately, you're not entitled to this deduction. The modified adjusted gross income is less than a specified amount, which is set every year, and if filing jointly, taxpayer and spouse cannot be claimed as dependents on someone else's return. In regard to the tuition and fees deduction, we mentioned earlier at the time this course went to print, some tax benefits had expired. These expired benefits include the deduction for qualified tuition and fees. In summary, we went over how to identify and claim adjustments to income, educator expenses, the deductible portion of self-employment tax resulting from Schedule C, penalty on early withdrawal of savings, alimony paid for 2018, the IRA deductions, and the student loan interest deduction. So now let's take a look at a few review questions.